Hello, everyone. Welcome to the market update for Tuesday, November the 15th. As always, if you have any questions during the week or any questions I don't get to here in the live class, make sure you send those to Jerry at TradersPro.com. That's Jerry at TradersPro.com. I'll be happy to answer those for you. Let's jump right in. Obviously, the focus of today was going to be on the PPI report that came out before the market opened, and that was because the CPI report came out last week, and the market had such a huge reaction to that people were kind of expecting the same type of thing off of this report. We were up. We're seeing a little bit of a reversal. A little bit of a mixed market here with the Dow being down a little bit, but also the internals. When you look at the price action of today, it's looking a lot more bearish, and it's looking a lot more bearish in a critical area, which we'll get to here when we look at the charts. We could be in a position here where we could get another leg down, and I'll show you what I'm talking about. We might need to hedge again a little bit in the portfolio, or at least do an initial hedge. As far as the direction alerts are concerned, we're still in a bear market. We have the momentum indicator in the extreme reversal risk range. Now, these can become even more extreme. We can move all the way to the far right side of that. So if you're looking at a chart and it still looks like maybe the market could go up a little bit further in your mind, well, this indicator is showing that it's possible it could go up a little bit further, but the fact that you're in this extreme reversal risk range means that it's stretched a little bit. You're dealing with a little bit of an overbought market, and not extremely overbought yet, but fairly overbought. This is what that means is the rubber band is stretched a little bit to the upside. It could snap back a little bit. The market could come back a little bit at any moment. Again, these are not immediate indicators. Stocks, particularly in bull markets, they can stay overbought for quite a while, and in bear markets, they can tend to stay oversold for extended periods of time. But what you do is you look at those conditions, and then you start to look at price action, individual price action, meaning those candlestick formations, to start to signal when it could start to pull back, okay? And we are actually getting one forming today that could mean that it starts as early as tomorrow, although you always give a little bit of flexibility with some of these patterns that they could delay a day or two as markets try to hold up a little bit or what have you. But we'll look at that here in just a second. So that's important to note that we're in an extreme reversal risk. For momentum, breadth is not quite there. It is high, but it's not quite in that extreme range yet. So there is a little bit of wiggle room there. Obviously, sentiment is in the extreme range, and near the far right side of that range. We'll look at what the VIX is telling us today, and the VIX is signaling a little bit of concern. And again, this could change with an hour or 2 hours left before the market closes. These candles can change a little bit, but I'm going to tell you what they're looking like right now. And if they stay like this or stay close to this, it could mean that we get a little bit of a pullback here in the next day or two. We'll see. But that's sentiment's been extreme, but it's been extreme for quite a while. So it's not like this is, earth-shattering news that I'm presenting here today. It's almost every week we see a sentiment indicator in that extremely complacent range, although that is important to note that it's been elevated for a long time. We really need to see it get into the fear range to really know that we've hit a bottom. And we haven't gotten there. We haven't been able to get there on these sell-offs during the decline we're coming up on a year since we started this decline in the market, and we haven't had a sell-off yet that's freaked the market out or panicked the market. And some of them have freaked the market out a little bit, but not panicked the market, and that's typically what we need to see to have a little bit more confidence that a market bottom is in. Now, again, you hear me bring that up a lot. I do want to point out, though, that although I think it's very important, and although I think it for me, it falls in the area of probabilities that, I have never witnessed a larger market correction like I believe we're in that hasn't had a panic sell-off at some point during it. It's just you see that enough times, and that's what you just expect. Am I hung up on it to the point where I can't accept a market trending higher if it just starts to trend higher from here and starts breaking out to new highs? Of course not. I'm a trend trader. In fact, I try very hard not to get too biased in one way or the other. So again, as much as I brought that up and how much I think that is going to be important in signaling a market bottom here, if we keep just grinding higher and we break above key levels, good volume on the breakout, good breadth, good participation from the market, I'm going to turn bullish and if I have to flip flop back to bearish again, I could do that as well. But I'm going to try to. My number one goal is to try to be on the right side of the market, not to try to predict what's going on. And that's what makes my job a little bit difficult sometimes, is because as a presenter, you're almost you're looked at to predict or to give your opinion as to what you think is going to happen next. And you can tell people that are more that really do focus on the trend, because they can give a prediction and it can be a pretty strong prediction and maybe have some passion behind the explanation. And then when it starts to not work or go in the opposite direction, does that same person try to defend their position? Meaning they dig in and try to keep defending what they think is going to happen and ignore that it's going against them and doing the opposite, or do they adjust and say, "Hey, I was wrong. That outlook is not taking place. This new one is what we need to focus on." Those are the types of people that you want to listen to, because especially if you're a trend trader, because that tells you that their main objective is not to be right. It's to make money. It's to pivot and be willing to say, "Oh, I'm wrong on this. It didn't work out the way I thought it would. Let's move on to this new direction, because that's where the money is going to be if we can get on that train and ride that train." So, wherever you are out there, whether you're with us or you're with anybody else, that's something to pay attention to. Is if you're working or listening to someone that is always trying to be right, goes to great lengths to defend why they were right, can't admit that they were wrong, and worse off, that they'll find reasons why they were right, or the worst case is when they can't no longer defend their position, then they start reaching for conspiracy theories. The market's rigged, and it's the algorithmic traders that are manipulating the market, and they can't seem to accept responsibility that they can be wrong sometimes. Those are the people you want to run from and not listen to, because they could lose you a ton of money if you try to follow them. All right, so sentiment still high. If you look at the buy-sell ratios, they are still relatively close together, so they're not showing any sort of extreme here. We could still push higher from this standpoint. New buys could increase versus the sells. So I'm not seeing any sort of stretch position from the new buys or from the buy-sell ratios. However, this sentiment indicator here has reached the sell area. It did pull back a little bit from it, but it has reached this area, so it is elevated. I think that's a little bit of a warning sign that we could be in for a little bit of selling here. So with the market stretched, not stretched overbought extremely, but in that pretty stretched condition, some of these indicators showing that it's overbought and hitting these key levels, then we have to at the very least, have a little bit of a cautious outlook. I wouldn't want to be jumping into a ton of new positions in this environment. And I might be looking to hedge. That is one thing I'm going to be looking to do, is to possibly fill in those hedges again on the portfolio in case we do pull back a little bit, that we can make a little bit of money with those hedges and hopefully not lose too much with the long positions we're in. I might also take a couple profits on some trades I'm in the portfolio that are a little overextended. I'll explain that when I get to that part of the class. All right, let's go through the charts here. And I want to start off with, let's go right to a 2-year chart of the SPY, because there's a significant downtrend line that we're following that we think we could rally to or get close to before the next move down takes place. If you draw a line and connect the tops right through here, this is not going to be a perfect line because I'm having to free draw it right here. You can see that every time the market has gotten up into that area, it's reversed. Now we're not quite in that area right here. I'm calling the area, the significant area between about 407 to 410. This line is sitting right at about 409, 410. 407 is actually where the 200-day moving average is. We don't have moving averages here on TradersPro, but if you were to pull up another chart and look at where the 200-day moving average is, it's near that 407 area. So I throw that in there in case the market is going to react to the 200-day moving average, which it does sometimes. That could act as a little bit of resistance there. You've got a little bit of horizontal resistance close by, kind of in this area as well, going back. Now, the problem is, and this happens a lot of times when you get later into these relationships where stocks start bouncing off the lines. When a stock bounces off a line once or twice, well, first of all, when it bounces off, you have to have at least 2 touches on the line to be able to draw a trend line. So we couldn't even draw the trend line until after the market reversed down off of this area right here. Now we had 2 areas to focus on, this high and this high. We could extend that line down. But the more times it touches it, the more people become aware of it. And it's not unusual that everyone's talking about the same area right here. You know, you say, well, you might be on TV and somebody says, oh, this 407 to 410 area is a key resistance in the SPY. You might say, oh, well, Jerry was talking about that in class today. Well, it's because I'm not the only one that can see that, and there's a lot of other traders that are focusing in on this area right here. So, and a lot of them are saying the same thing. Every time it's gotten to that area, it's pulled back. It's gotten this area, it's pulled back. And so a lot of people are waiting for it to get to this area here. Well, sometimes what can happen is you could get a reversal a little bit sooner than that area. Why? Well, because it's human nature to not want to miss something like that, right? That seems like an obvious move, and you know, it's like, you know, what if it reverses strongly, or I've got to be working this day, so I might not be able to watch it that day. So I'm going to get in early and anticipate it's going to reverse and go down. What can happen is that it could start to reverse before it gets to those key areas that everyone's looking at. Okay. You know, it's kind of like having the runners line up for the 100-yard dash, right? They're ready to go, and you don't want to be the last one out of the chute, right? And so, you know, you tend to have some of these people that false start. They try to time it a little early, try to get a little head start, get a little out in front of it early. And again, that's human nature. And so I think what we could be seeing today is maybe that's what's going on. Maybe this market might reverse a little bit earlier than this area that everyone's kind of focused in on. Now, I don't know that for sure. And sometimes you get early reversal signals that get shaken off, and it does move right to where you thought it was going to move to. But by not necessarily having to come all the way to this area here, it has a number of times here. But look at the behavior on this whole move down. We hit a new low right here. Here's the first time we touched that line. Now here we went down to a lower low. Here was another lower low right here. On this rally right here, we only went halfway. We didn't get back up to that line before going to another lower low. So it did go to another lower low there. Here it came all the way back up and hit that line. Now when did it go to a lower low again? It went to a lower low down here. And so it didn't get all the way up there in this case. Could it be here? It doesn't necessarily have to get all the way up there in this case. We'll see. Okay. That's something to kind of pay attention to and keep an eye on. Let's zoom in a little bit closer here. And this is what I want to focus on today is you've got this bearish reversal candle. Now, this is one I talk about all the time. You need to have a context with it, though. You have a run up ahead of it. You get a run up ahead of it. It opens higher. So what happened this morning? We got a gap up off of that PPI report. Not really any follow through. I was watching this all morning, waiting to see if it was going to take off. It wasn't taking off. I actually got out of some bullish trades, shorter term trades that I was in because it wasn't acting like it wanted to go higher. Remember when it had the CPI report back here, it gapped up and within that first hour or so, it started taking off. It had a little bit of a pullback initially, but then it really started taking off right after that. This didn't here. It gapped up, tried to maybe rally a little bit, and then it started to slide. Okay. Now we're trading lower than where we opened, and so remember the S&P. If you look at the S&P index, it's showing that the market is up right now. In fact, if I can see something come across right here, I'm not looking at a chart, but it's not going to have it on right now. Oh, wait, yes. It's showing that the NASDAQ is up. Oh, it just flashed it. I didn't see it. Well, we can just pull up here. Let me just look at here. Yeah, 1.5% right here. But that's misleading because it's not explaining the reversal that's kind of taking place, okay? It opened up here, it's trading down here. It's trading lower than where it opened, but still higher than where it closed here the day before. By the way, yesterday's candle was actually a bearish candle. Normally, I would have shorted some stocks or bought put options off of that price action right there. The only reason why I didn't was I knew that PPI report was going to come out, and it was a binary event. It could go either way. We already saw it last week. This is how the market looked right before the CPI report came out. It was very bearish. It tried to rally, had confirmation of a move down right here. It should have gone lower, except that CPI report trumped everything. The market shook everything else off, whatever the trend it was heading in at that time, and reversed it and went up. So, I didn't want to do anything yesterday, even though that was a bearish candle yesterday. Now we attempted to open higher again. It looks like we're going to fail. Now, again, we still have an hour and a half. What happens if the market rallies all the way back up? Well, even if it rallies all the way back up, the price action would still be fairly bearish because it was showing weakness, and buyers were able to push things higher, but maybe they're not able to even push it. Let's say they were able to only push it back up to where we opened. They didn't gain any ground. That's not a real strong signal. It's kind of a showing of buying exhaustion that can be taking place. Okay, so this is showing a little bit of a bearish price action. Now, one possibility is that this is a completion of a bearish ABC pattern right here. By the way, not all the indexes look this way. But this could be a bearish ABC, and maybe we're starting a bigger move down, or maybe not. Maybe this is just going to pull back a little bit, and maybe we just kind of, maybe it just pulls back and then goes higher again, and we just start stair stepping higher. I don't know. I'm not ruling out the fact that this could just be signaling a move up to this little trend line. You got a trend line there, you got a trend line through here with the upper part of the range. Maybe we just move to the bottom part of the range. So I'm not trying to draw any sort of massive sell-off here, particularly since we're in what tends to be a more bullish time of the year, this time of year. So, we don't get too many market crashes in this time of year, but they have happened before. We've had some December crashes that have happened before that nobody thought could happen, because you get so caught up in the seasonality. I'll never get market crashes in December. If the crowd starts thinking that that's not going to happen, that's when you have to worry, because that's when it's probably going to happen. But just at the very least, it looks short term that it can pull back off of this price action right here. You go up to the direction or the reversal risk. You're just entering into the extreme reversal risk. So I mean, it still could go a little bit further. It could still rally up a little bit further. It's just that the price action right now isn't showing that it's going to rally up any further. So I would tend to be leaning more towards a little bit of a pullback here over the next couple days. All right, now let's take a look at some of the other indexes. The Dow is obviously outperforming. Okay, it looks like it's in an uptrend, and it doesn't look like it's going to have a massive pullback. At least not looking that way just yet. But it is bumping up into this resistance up here at about 343. That was a previous high. You're getting a bearish reversal candle yesterday and today, that could indicate a little bit of a pullback. Let's put this in context a little bit right here. We're just barely flirting with breaking to a higher high. We haven't done that. All of these have been lower highs, lower lows during this whole decline. I think that's something I've been pointing out on the Dow to watch, because that would be very significant if it could do that. Now, another possibility is it could still be. It could still show the Dow is bottoming. Could we, if we did get a bigger sell-off, could we get a sell-off where the Dow comes down into this area right in here, and it creates kind of an inverse head and shoulders pattern, and then makes a much bigger move up where it breaks out of everything later on? That's a pretty big pullback, though. That would be a pretty big sell-off in the other indexes as well. But that's something I was looking at. If it did start selling out pretty big, I'd be really focused on this previous low right here, because that would be the stopping point. If it is going to be that inverse head and shoulders pattern, it should stop right in that area right there. This is further off, though, because we don't have any sort of big sell-off taking place. But if it does, these are areas that we'd want to pay attention to if it does happen. Obviously, if it shakes this off, or maybe just remember, these candle formations are very short-term in nature. What if we just shake this off? Let's go to 6-month chart here. What if this means that, we drop just a little bit, and then we break out above here? Obviously, if we break out to that higher high, that'd be very bullish for the market. But again, what's bothered me is that the Dow isn't the index that usually leads the way out of these moves. It's usually the NASDAQ and the chip stocks and transportation stocks and things like that tend to be the leadership group. So that's been bothering me for a long time now, and I'll keep bringing it up just because I don't want to. Obviously this could be the one time where it's different, but I want to make sure I'm not just quickly jumping to the lower probability outcome. I still want to make sure that I'm focused on what normally takes place, so that I can make sure that I'm not ignoring the higher probability move and quickly grabbing onto the lower probability outcome. All right. The NASDAQ, you can see, is underperforming. NASDAQ, you can also see it's rallied sharply in the last couple of days. It's in that extreme reversal risk, although not to the far right side. We'll note that. Bearish reversal candle today. Again, possible bearish ABC pattern. It's been underperforming the indexes. It wouldn't take much for this thing to come back and retest these lows, if not go a little bit lower. I'm not saying it's going to happen right here. But that's something to kind of keep an eye on over the next couple of days. The resistance, let me go back here. The resistance here on the Qs, you've got some resistance right where we're at in this 291 area right through here, this previous low. You can extend that out to where, you've got this low and these highs. They're not exactly in that area, but there's a little bit of congestion in this area here, which is maybe why we're seeing a little bit of a reversal. This is also a significant high up here, and this is going to be a significant high on a lot of the indexes because the Dow has already broken above that September high. We're waiting to see our other indexes going to follow and do the same thing, and so that's up there around 310 to 311 if you want to mark that on your notes or what have you on the QQQ. And then the IWM, again, it's right at that September high. Yeah, that's at about 189, 190 area right through here. Now this has a more of a indecision candle today, called a spinning top. Usually those need a little bit more confirmation. You'd want to see, does it drop the next day out of that? Do you get to move down off of that? But it is showing indecision at a key resistance level. I think that's worth noting. We'll quickly go through some of these other charts. The TLT, obviously, we've been keeping an eye on bonds. Bonds are looking like there's a possibility they could be in a trend reversal. They've been so beaten down that, at some point they've got to bottom out and reverse. We saw a lot of capitulation right into here, a lot of volume right into here that can indicate a potential bottom. The thing I am still a little bit worried about, though, is that I'm still looking at the possibility this could be a bearish ABC pattern right here, leading for another move down. We're right at a spot where that wave C looks about the same length as wave A. Now, if we keep taking off and wave C looks twice the length of wave A, it shouldn't be twice the length of wave A. There are rare cases where an ABC pattern could have a wave C twice the length of wave A, but it'd be very rare. It usually isn't that way, and so when it starts to really look like it's much longer than wave A, you start to say, hey, maybe this isn't a correction for another move down, but maybe this is the start of a 5 waves up, and we're in wave 3, 4 or 5, and this thing's the trend reversal is underway. Now, obviously, with bonds having a significant rally, it means bond yields would have to come way down. It's hard for a lot of us to see that happening right now. But we've seen crazier things happen. So, I think what's probably more likely is that if this is a bottom right here, what we see is a lot of basing going on, a lot of sideways, drawn out movement for the next few months or so. Because I just can't see bond yields dropping that fast that would cause bonds to go higher that fast. So that's kind of what I'm anticipating. And obviously, if bond yields go higher and we just head lower here, then obviously that was, in hindsight, we could see that was a bearish ABC pattern, just a correction for another move down. But again, we did break this trend line through here. This is looking more sideways through here. It could be it's possible it could be basing. What we look for is, do we start getting slightly higher highs, higher lows, but still more sideways looking? We'll see how that plays out over the next few months. Gold taking off. We talked about this. It is in an extreme reversal risk area right here, far right side of that extreme reversal risk. But it can stay there for a little bit. As I mentioned, when gold starts to go, when some of these commodities start to go, they go, and they can stay overbought in their trends for quite a while. But we talked about this in relation to the dollar coming down sharply. Gold was starting to react, and gold had been beaten up quite a bit. It's now gone to a higher high right through here. It's held kind of an even low down through here. And so you want to pay attention to this next high right here. Can it break above that? Now, we saw it, just showed you that it is in that extreme reversal risk. So maybe it pulls back to this breakout and retests it, and then works its way higher. If it does come back and retest it, it could be, and especially if it pulls back in kind of an ABC pattern, back and forth, a little bit choppy back and forth, you could get another entry point into that if you want to trade it. Although you'd probably be better off trading the gold miners. There's a lot of pretty good looking charts on some of the gold mining stocks. That'd probably be a better way to trade it. The dollar we've been paying attention to, this is oil. We'll get to oil first and then the dollar. Oil has been sluggish. I mean, we broke out above here, but then came right back down. We still technically have a higher low right through here, but this was a weak day there, and then a weak day yesterday. We kind of reversed back up today. Bottom line, this thing could still, there's a lot of support in this area right here. We could still see it come down into that area and still be bullish on oil. But I'd like to see oil start to take off again, break out above these highs. We've had a lower dollar and not a very big move up in oil. And I know there's other factors. It's not always that relationship, okay? And there's a big deadline coming up in December where the embargo of Russia oil will kick in officially. Maybe that's an event that everyone's looking at is when oil could start to take off, or not. I mean, maybe there's the agreement works out, or maybe there's a ceasefire in the war or something like that. I don't know. Again, I'm not a commodity expert. I'm just focusing more on the charts and what the charts are telling me. And right now, the charts are telling me it's a little bit sluggish. But we've been doing pretty well with some of our oil trades and energy trades. Haven't made a ton because it's been a little bit more sideways and choppy, but it's hasn't hurt us on what some of the market days that when the market sells off. Some of those energy stocks have held up pretty well, so it's actually worked out pretty well in our portfolio. Reduced a little bit of the volatility so far that can happen in these types of conditions. The dollar continues to fall now, and I pointed out the last couple updates that the market is focusing on this. Anytime the dollar has been up, the market has been down, and time the market has been down or up, the dollar's been down. It's had that inverse relationship, and again, I don't know how much longer the market's really going to focus on that. And I mean, it's moved like intraday movements. You'll see the dollar like on this day right here where the dollar started to it started to rise up into here, and the market started selling off a little bit, and then it started to slide back down, and the market started to rally a little bit just as it was moving tick by tick almost. So a little bit of a bullish reversal candle here on the dollar, which is expected. We're in an extremely oversold condition in the dollar. You can see right here it's all the way to the left side and the far left side. So we're due for some sort of a bounce. But see, again, we line this up to all the other clues we've been looking at. The market's looking like it's having a bearish reversal candle today. We're at resistance levels for the market. The dollar is showing a bullish reversal candle in an extremely oversold condition. We could get a little bit of a market sell-off right here. There's a pretty high probability of getting a little bit of a market sell-off right here. Again, not calling for a massive sell-off here. I don't see anything, like I said, that would be the trigger for a massive sell-off unless there's some news we don't know about. Maybe crypto related, because we have started to see the rumblings of crypto. Remember back in the financial collapse, remember when Lehman Brothers first reported they had trouble, or was it Bear Stearns? Was it Bear Stearns at first? I think was it Bear Stearns? I always get it mixed up. One of them reported they were in trouble back in like May of 2008. April or May, it was early. And it shocked the markets. The markets freaked out a little bit, but they're like, oh, it's isolated. It's just them that are having the problems, and everything else looks fine, and we're okay. Everything's okay. And then it was that month of September where all hell broke loose. And I think that's when it was Lehman Brothers, and I don't know. I always get them which one started. But then it snowballed from there. Well, could the same thing happen with crypto? Well, crypto doesn't have as big of exposure to the world markets to crash them like that, like the financial collapse. But could it be that this trickles down into other areas that where we start to see other problems, other areas where people got too leveraged? And remember that whenever the market starts selling off or we get into a recession, the old Warren Buffett phrase that, when the tide goes out, that's when you know who doesn't have their swimming trunks on. When these big when these market sell-offs happen, that's when you find out when people misbehaved, where they over leveraged, they got too greedy, they risked too much, and they were hoping that everything would just be fine until I don't know when, until they made enough money, which is never enough. They keep overdoing it until staying over levered until it crashes. It's just human nature. It always happens. We always see these things happen during these major market pullbacks. We just never know where it's going to come from. And now it seems to be coming from crypto. It could be from other areas related to that. We are hearing some rumblings of credit exposure. A lot of individuals are maxing out credit cards. We can understand why. It's inflation. It's people are living paycheck to paycheck, and then suddenly, that paycheck can't pay for the things that they need to pay for. They put it on their card, hoping it's temporary, hoping they can pay it off. And then now with interest rates rising, now to pay it off, it's 5 times as much to pay it off as it was when they first charged it. And this is how things can build towards these collapses. It starts out gradually, and many times it starts out innocently. It's a medical bill. It's not like they're going out and buying a new fur coat or something. There can be real life expenses that they're trying to get by with those cards, and then they get into trouble. Bottom line, though, is that we could see a little bit of a bounce. We're due for a little bit of a bounce in the dollar. We'll see if that leads to any sort of market reaction, negative market reaction because of it. Now, it doesn't have to. That isn't always the relationship with the markets, that if the dollar goes up, the markets go down. But it is right now. That's what the markets are kind of focused on. So we got to pay attention to that relationship right now. The VIX, we saw probably the biggest significant move up in the VIX that we've seen for a little while today. Now, let me go to the other VIX chart here, as I normally do, because it has the numbers that we like to look at. 30 is obviously when the market is freaking out. Now we have backed off the highs. We were all the way up here when class started. We've come off the highs a little bit, but again, the fact that we spiked up like that is a little concerning. Now, usually when the market has gotten down to this 20 area right here, that it starts to sell off. Okay. But this is what I was pointing out earlier is we're close. We got down to 22 a couple days ago. We're getting a spike up a little bit today. We'll have to see how that closes. Like I said, it's off the highs a little bit there. You combine that with the bearish reversal candles we're seeing. Maybe it's one of those situations where it starts to go before everyone thinks it's going to go, because there are a lot of people talking about the VIX being down at 20, and that'd be bearish for the market if the VIX gets down to 20. And so it might be that we see it happen before then. We'll see. Like I said, this all faded quite a bit in the last few minutes, and we get a lot of that this time of day, and we've seen a lot lately where we've seen some of these. Well, yesterday, remember we were rallying, and then we really faded into the close right at the very end. It just kind of slipped right into the close there. I'll take a look at those charts again real quick after we finish this. But the VIX showing that reversal, chip stocks, SMA showing a bearish reversal candle. Although one thing to point out on the SMH, remember how much it was lagging back here, and I kept pointing that out. It's starting to catch up. This was a very powerful move in the chips. It's not quite where the Dow is. The Dow is kind of up in this area in context with, or actually up here. It's almost at this high up here, but it caught up pretty fast. And remember what I said a few weeks ago? I said, but down here, I said either the chip stocks are leading the way down, and we're going to see the Dow have to come down to follow them, or we're going to see the chip stocks catch up a little bit. Now, that's usually not their role. They don't usually play catch up, but you can't ignore that move. That's a pretty powerful move, although that's a bearish reversal candle today. And usually you get some sort of a pullback off of that type of price action. Could just be very short term, but usually you're going to get something off of that. Same with transports. They've kind of caught up a little bit, although again in context, the Dow's up around here, but they've caught up a little bit more. Had a pretty strong run through here. Bearish reversal candle right there. We'll see if that is going to lead to anything in the next day or two. Question, are you aware of the Russian missiles landing in Poland that caused the VIX to rise? Could have been. Now, the VIX is not, you got to be careful to point to that as exactly a reason why the VIX, remember what the VIX is showing you. Is it showing you the implied volatility changes of the S&P 500 index options? Now, could it be that professional traders are buying protected puts on a news event like that? I haven't been following that, so I don't know what the details are of that. But could it be that they're hedging a little bit with that? Yeah, that could be. But you got to be careful sometimes to draw exact conclusions to every movement of the VIX, or find a reason for every movement of the VIX. You always want to remember what it's telling you is that it's telling you professional traders are concerned, but not the average trader. We're talking about professional traders and whether they're hedging ahead of that now. But we do see things like that. We did see the VIX move up a little bit ahead of that CPI report. It has before Fed meetings sometimes. If it isn't quite sure how the market's going to react. The reason why I like the VIX is because it's not just an opinion of these professional traders. They've got to back it with money. They're having to spend money to hedge, and they don't want to spend that money to hedge if they don't have to, or if they don't feel like they need to. And so it's not just an opinion. It becomes more than just their opinion or what have you. It's hey, they feel like it's they're worried about it enough to where they're going to pay a little bit of extra to buy those protected puts. So always remember that when you're analyzing the VIX, and don't ever base a trade exclusively on the VIX. You want to make sure you're looking at all the different clues in that situation as well. All right. And be aware too that sometimes there are professional traders, particularly during lunch hour. This is why I don't trade. Try not to make any trade decisions between. Well, actually, I try about 11 Eastern to about 2 p.m. Eastern. There's a lot of traders that have specific strategies. These are big money traders that manipulate the market during that period of time when professional traders are at lunch. They try to take advantage of amateur traders that are stepping in on their lunch break to try to trade, and they often move the market in these little swings back and forth sometimes, and so and they try, if they can get a news event to do it, it helps them out a little bit. So you always want to be aware of that time period and I'm not saying it can't be something significant, but try not to overreact if some news item's coming out in the lunch period, and especially if the market seems to be reacting to it during that period. That's why I'd like to see how it looks towards the end of the day. It's a little bit more, a little bit more solid as to how the market is reacting. All right, Bitcoin. Not going to spend too much time here. Bitcoin took that massive hit last week. It's trying to recover here, but this just looks like it's a corrective move. We should probably see some further downside, although that panic selling was fearful enough to be what we would look for at a bottom, a market bottom. The volumes were extreme. I pointed this out last week. The bottoms don't always happen with one massive sell-off then go right up. We could still go lower again. That could be the panic sell-off we'd be looking for. We could still go a little bit lower, but that was an early signal that Bitcoin could be in the bottoming process, and especially from a psychological point of view, because I don't know too many people that really are excited to run out and buy Bitcoin. It doesn't feel like it's safe to buy. A lot of people would probably talk you out of it if you said you're going to buy cryptocurrencies right now. They'd probably say, "Oh, all that stuff. All I hear is that stuff is crashing and people are losing money." That's typically what a bottom feels like, and so it's starting to act more like a bottom, and we'll see how that kind of plays out. Now, I've not been a big crypto trader, so I'm not going to be one to run out and buy it just because it's acting like a bottom. But now there's other things you would need to look for. You'd want to look for the chart to start to turn and start stair-stepping up and start acting like an uptrend. But if you want to get a general feel of what it's like at a bottom, that's what we're looking for in our markets, is to get to that point that where they are in Bitcoin, where it's like, man, I don't really want to own this, and how much further is this going to drop? Because you got to remember, back here, everyone was talking about this being a base right through here, that Bitcoin was basing, and it was going to start moving back up. And then as soon as we dropped right here, you stopped hearing those people saying this is the bottom. It was like, I thought this was the bottom. I thought we were going to start moving up from here. I don't feel safe anymore to buy because I wasn't expecting this. This was horrific. And that's what usually happens in these bottoms. If too many people think we're at a bottom, we're not at a bottom yet. And that's what was taking place right in through here until that big sell-off happened. Not to mention you get the scandals and the bankruptcies and things like that always seem to follow market bottoms. There's a lot of these big startup stocks that happened during the COVID bubble. They're going to go out of business. Carvana could be going out of business. I still see their commercials all day long on TV, but they're not looking good. That's typical of when these things end. You see companies that, I remember the .com. There's companies that everyone knew their names and talked about and traded, and then now they no longer exist. That's going to happen. It's going to be that consolidation that takes place. We're going to start to see some of these big names that you didn't think would go under that are going to go under. All right. IO corporate bonds, bearish candle today. Market's been kind of following that as well. See if that continues to be a little bit of a leading indicator. Yeah, the SPYs have come off the lows a little bit here, but it still has that bearish reversal candle. And even like I said, even if the buyers are able to push it back up to where it opened, that still would be bearish. It would still form a bearish candle, that they weren't able to close it higher or push it too much higher, or it took a lot of energy just to get it back to that point. We could watch that a little bit, but across the board, there's a lot of bearish candles forming, and they're forming in a market condition that's in kind of that extreme reversal risk range. Again, I need to emphasize, I'm not saying this, I'm not calling a major panic sell-off here. It could just be a pullback for a couple of days, but the market is signaling it should pull back here pretty soon. Probably sometime this week it should start. All right. So the portfolio, a couple of things I did. I can't remember what I did in the last class compared to this class, this one here, but I did get out of Lockheed Martin and Northrop Grumman. I remember on Lockheed, when I got on this one, I said this could be wave 1, 2, 3, 4, 5. I thought I might be getting into a last wave here. Well, that was probably it. That was probably wave 5 right there, and I got stopped out. I had my stop right below here. I got stopped out on that big down day last week. That was Friday. And that's okay. I didn't lose very much. I had a very tight stop on that, initial stop on that. And there's been a lot of volatility in these defense stocks. I like them, but man, look at Northrop Grumman. Had this big drop right here. I stopped out of that one, and then it's big move up today. These are ones I still want to be in because I just see that they're going to be making money for a long time, but it's hard to kind of manage them with the volatility that they've been showing. So if I see more bullish market conditions, I'll probably look to see if I can jump back into these again. So I'm kind of keeping them still on my radar because I'd like to have some exposure to those if I can. Now, let's go through the list here real quick. LNG, again, I got my stop down here. It's been just kind of a little bit sluggish, but it's still, this whole pattern still looks bullish. It just hasn't really gotten going yet. Maybe, again, as we get further into the colder months, we see this take off, or maybe see what happens in that December deadline. I think it's December 5th, if I'm not mistaken. MPC down a little bit today, but the overall trend still looks good. No reason to get out of that. Tech, again, a little bit flat here, but no reason to get out of that one. It still looks good. TEIX got really close to stopping out. A lot of times, it can depend on the day and the market conditions for me, and that's why, when I get asked about stops, and opinions on stops. The biggest thing about stops is you've got to develop a trust with yourself that you can take a loss, that you can stop out of a trade. And if you can trust yourself to take a loss, and you know that you don't have a problem recognizing when you're wrong, then you can have a little flexibility in how you stop out of trades. On Northrop Grumman, if I go back to NOC here, my stop was actually down here. I just kind of put it in this range down in here, kind of below this kind of, there's some congestion right in through there. Well, we had this big down day, and I wasn't yet at my stop, but Lockheed Martin had that big down day, this had that big down day, and I went ahead and stopped out of it. Because it just was acting like it still had further to drop. And although I wasn't at my stop yet, technically yet, I went ahead and got out, missed that next move down, but it came also rocketing back up. Actually, I probably would have, if I got out today, I would have probably gotten out. Well, maybe a little bit better than when I got out of on Friday, but. So CEIX, a lot of times I like to get out when it's going to close below my stop. And you did have an intraday low here on CEIX, but it was off that low. But I'm telling you, sometimes I'll go ahead and stop out. I mean, that's the thing. I allow myself a little bit of flexibility to kind of read the market. The markets were still very bullish at that, still looking bullish at that point. It just so happened this dropped on that day, and so the oil chart still looked good, and I wasn't going to close at my stop, so I went ahead and held it. Now, it doesn't mean I'm right. We did rally off of that last couple of days, but it could mean that we come right back down below it again, and I'm still prepared to stop out if we do. But the point I'm trying to make is when you know what you're looking at and you know how to read things and you want to base your decisions on, I want to get out, I want to stop out if I know I'm wrong, then you can have a little bit of flexibility in your decision making. But the problem is if you don't want to take a loss, you can't feel like you can take a loss, then what you start to do is find all these reasons why it's still going to go back up. The stock could be down here and you should be getting out, but you're like, I'm going to wait until the end of the week to see, maybe it was the end of the day to see if it can close back above there. Then it doesn't. And you're like, well, let's give it till the end of the week, because maybe on the weekly chart, it's not going to close below it on the weekly chart or something like that. You start making up excuses to stay in the trade, and because you don't want the pain of taking a loss. Okay, well, that's the problem. That's what most people have to deal with, and that's why most people struggle. So what you do in that, to start off with, you start with a strict stop loss plan. If you've never done stops before, then you say, as soon as it trades below this low, I'm stopping out. I don't care about the close or anything. I'm going to stop out as soon as it goes below that low. You might even actually put in an actual order to automatically trigger if it drops below that low, and that's fine too, because you've got to learn to develop the discipline. And once you learn that, okay, it's okay to get stopped out, it didn't kill me. In fact, I probably saved a ton of money if this thing kept going lower. And and obviously your other trades are working out as well, because you got to be able to see your success as well. Then you're more able to be willing to take that loss and stop yourself out of the trade. And you've seen, if you follow I've stopped out tons of trades on this portfolio. You've seen I've never had a problem doing it. All right, so that that kind of explains that one, why I'm still in that one. CF has really just been frustrating. It's just been, look at these moves back and forth, up, down, up, down, up, down, big down, up. It's just sideways. And look how almost all of that is contained within this one candle right here. I think that's something to really focus on. We're not, if we break out of there, if we break out above this high, solid breakout, close. You see all these intraday highs not closing above there. I don't know why, but that is clear as day. That's significant. And then this low down here, it can't close below that low. If one of these is going to be the break, and when it does, that's where it's going to move. When it breaks it, it's going to move in that direction. So far, it's been bumping up against the top half here, so I don't see a reason to stop out. And actually, my stop is down below here. I could probably move it below here, because if it goes below there, this thing's probably going to head down here and stop me out. But I'm not going to move it right now. I'm going to give it that little bit of that flexibility. Now, gold, I went ahead and bought AEM. Now we're getting into the extreme reversal risk right here. We've got a bearish reversal candle. What I'm a little bit concerned here is that we could pull back a little bit to that breakout area. And I don't want to have this much exposure with the market looking a little bit more bearish. So I might jump out of this one and just take the profits I made on this one. Now, again, some of these trade management decisions I'm making right now are unique to these conditions. You know, in normal conditions, you could wait for it to go to a sell signal to get out, or wait for the short-term trend to go from a long-term trend, or for the a short-term trend change from green to red or something like that. You know, there's a number of things you could do in kind of a bull market to manage this. And I just got done saying that, you know, sometimes these gold stocks, they can stay overbought for a little while. But with the dollar looking like it's got a little bit of a bullish reversal candle, could rally a little bit from a very oversold condition. Again, I can jump back in this thing again. Let's see if it comes back and retests. And the bottom line is, I don't want to have this much cash out in trades. I don't have this much money out in trades, so I'm looking for some that I might be able to pull out of right here to reduce that overall risk exposure. And then I'll hedge the rest with either the SARK or the SOXS or both. But I'm going to go ahead and exit this one here. And it is at 48.12. I only made $85, so that's not a big whoop there. Now, silver I'm going to hang on to, although I could probably get out of that one as well. But I do like the chart of silver a little bit better, and it's not in the extreme reversal risk range here, although it does have a little bit of a bearish candle today. Go ahead and keep that. And then I'm going to get out of the SPY. We were just trading the market. Again, bearish reversal candle, VIX moving up, all those reasons that we could see a little bit of a pullback in the markets. So let's go ahead and exit. And what was that trading at there? Let me. $400.09. 0.09, 15 shares. $148 remain on that one. All right, and I added ADM in. I told you I was going to get back into this one. I added this one back in. It looks like it broke out, came back to the retest the breakout. Had a little bit of a bullish inside day yesterday. Not really looking great, although it's off the lows of the day today, but we'll see if this one can kind of take off. Can't remember where I put my stop on that one. I'm going to go back and check. Stop at 91. So I've got a pretty tight stop on this. I just have it right below this low right here. And I think I did that because the market conditions, we're moving into that resistance area where we could get a little bit of a market pullback, and I didn't want to risk very much. So we'll see what happens there, see if that holds or if I get stopped out. All right. And then I told you I wanted to add a hedge. Let's look at SARK. This is the strongest bullish reversal candle. Let's look at SOXS. That one's a little bit better, and it's going from an extreme. So we got extremely oversold combined with a bullish reversal candle. Open down here, it's trading up here. It's still lower than where it closed the day before. That's the bullish reversal candle. Now again, all I'm using this for is if the market goes down, this should go up in value. Maybe it doesn't. Maybe the market goes higher and this will go down. That's the risk if you're going to hedge. But I already have long positions, so if the market goes up and this goes down, I should still be okay. Now, I didn't have much of an area to put a stop because we're kind of at new lows right here. So I just picked a number down a little bit lower at 27. Just down and right around here. It'd be a pretty tight stop. Let's do about 250 shares. It's about 8,000. Portfolio risk is less than 1%, so that's good. All right, I'm gonna go ahead and purchase that. And then if we do sell off tomorrow, I can always add the SARK. I just like this one. This looked more bullish to me than the SARK chart did. So. All right. Real quick, and again, market conditions right now aren't ideal. We could be pulling back. Really shouldn't be getting into too many new long positions. But, just to give you a couple ideas of patterns, I'll stick with the muscle stock, new buy scan here. There's a couple, they're in pretty safe, at least have been safe areas. And energy, this YPF right here. Let's go to a 6-month chart. 98 strength rank. A little bit of a bearish candle right there, but I like the trend range right there. So maybe this pulls back to the lower range if the market sells off. See if it holds. You can always look to get back in. I wouldn't be looking to get in this one today. It does have a new buy signal. And if you're just wanting to go off that signal and say, well, I don't care about the back and forth, I could, you can put a stop down below here. If it does pull back, it shouldn't break that. If it does, you probably want to be stopped out. And then the second one was, muscle stocks here. The CVI Energy 98 strength break. And again, you can see it's getting ready to break out. I have a double bottom pattern right here. I would probably wait for the breakout, get a clear breakout right there, but this thing looks like it could take off. All right, that's all I have. We'll see what happens over the next day or two. And Thursday, we should have a better idea of how things are going this week. All right, thanks, everyone. Have a great week. See you on Thursday for the stock-specific class. Bye now.